Welcome to Trade Ideas. I'm Alex Rosenberg here with David Levine, founder of Odin River, and also some know you as the Paranoid Bull. Thank you for joining us here at Real Vision.
Great to be back.
So help us make sense of these markets here, because with so many, as we are talking on Monday morning, the S&P is up 1%. A lot of up 1%, down 1% seems to be the norm these days, and people are really trying to figure out what's driving the market now and what will drive us in the weeks, months, and perhaps a year or 2 years ahead. So if you were to tell us what the stakes are, what the market is trying to figure out right now, what would that be?
Well, it's good to put this in context. So what's really interesting, if you look at the S&P 500 today, it's around 2,900. Last January, the end of January 2018, the S&P 500 was higher than it is today. Last August, it was higher than it is today. And what's really interesting is that there's been a variety of different narratives that have taken over in the first half of this year, because we bottomed in 2018 at the end of December, has been quote unquote bullish. There's been a lot of confidence. Volatility settled down. What's really funny, though, is that confidence was based on tweets, was based on a back and forth trade policy, was based on the idea that Donald J. Trump will control the markets up and down ahead of the election and get reelected. The narrative didn't really make sense if you think about it. So if I look at the last 2 weeks, where the markets are up and down, where equity market volatility is up, where treasury market volatility is up, where the bond yield curve has been inverting, that's a little bit more normal, in my opinion, given how volatile the real world actually has been since last January. Remember, last January was the beginning of the end of the top of a bull market. We had 90% of asset classes globally down in 2018. And so what happened in the first half of this year, in my opinion, is sort of a bear market bounce. We had volatility settle, we had correlations go back up, and so a lot of confidence in a narrative that maybe, in my opinion, wasn't really justified. So what we're seeing now is more uncertainty. We're seeing that across various different markets, and in my opinion, that's more reflective of the fundamentals. So I think what's happening is markets are becoming more normal. What we were seeing the first half of the year wasn't very normal. And so what I expect is more of the same. More volatility, more uncertainty, and markets beginning to reflect the fundamentals that we know are very volatile in the real world. Now, which fundamentals will matter most? We'll see. Trade war is very important. Global slowing in China, very important. Yield curve inverting, important. $16 trillion of negatively yielding sovereign credit, important. US economy, are we in a recession? Important. So there's many different questions, primarily macro related, that need to be answered in the coming weeks. Those will probably determine the fate of things, but I would expect more volatility like this and more uncertainty, and maybe even narratives taking hold again, like everything's going to be fine, or maybe not. We'll see what happens in Hong Kong. There's a lot of uncertainty, but in my opinion, a little bit more of a normal market in the last couple of weeks than what we saw before.
So I'll let you play a little dealer's choice here. And of those questions, which one do you think that most investors are getting the most wrong? Where is the most, where's the biggest problem in investors' thinking when it comes to this market?
There's one thesis that I've been talking about for the last period of years, and I call it the myth of the infallible central banks. Meaning, in order for systemic risk to exist, there has to be an assumption that everyone's making that later turns out to be wrong. And it's got to be very, very big, and most people have to believe it to be true. Right now, that assumption, in my opinion, is called the myth of the infallible central banks. So embedded in a variety of these different assumptions that people are making about the markets is the idea, don't fight the Fed, don't fight the BOJ, don't fight the ECB. In my opinion, that's just not a good assumption to make. Meaning, central banks have limits, those limits are political, those limits are legal, and in the United States right now, we had all the former Fed chairs write an article in the Wall Street Journal just in the last few weeks questioning the Fed's very independence right now in the United States. So confidence is also very important for central banks. So what I would say is, what level of confidence is the right level of confidence in central banks is a very important question, and how this myth of the infallible central banks kind of becomes unwound in the coming weeks and months is very important. And that could happen in a variety of different ways. Two most obvious ways where we see that happening today: in the banking system, the European financial system, European banks, we know they're under pressure, near all-time lows. Japanese banks, under pressure, near decade lows. And the fundamentals of those banks have been challenged very much by central bank policy in Europe and Japan. The second most obvious place this is showing up: $16 trillion of negatively yielding debt, primarily the majority of which is sovereign credit. $16 trillion in negatively yielding debt should never exist. That was created by central banks. So we have these very big market signals that are already occurring, which are kind of showing us that we're reaching the limits of central bank power and central bank credibility and central bank effectiveness. So as those unfold in the coming weeks, I think that those will be very important weeks and months, actually. Those will be very important themes to watch unfold.
Let's just drill down a bit on the negative yielding bonds, something that has sort of crept into the conversation as the Overton window is being opened about something that could happen in the U.S. as well. I guess I'm trying to understand, because to me it seems like a success of central banks that they were able to make people buy negative yielding bonds, by setting rates negative, and seeing that translate throughout the curve of the risk spectrum as well. I mean, people talking about negative yielding mortgages now. What's sort of your thesis about why that's so problematic and what it means for the future of central banking?
Oh, sure. It's just really, really basic. So if I lend you money, I need to be compensated for that risk. We know for a fact, not hypothesis, fact, systemic risk exists. In 2008, it was proven beyond a doubt that if you have a credit bubble, you can have systemic risk. And that can show up immediately across the entire world. We almost had a global financial system collapse beyond repair in 2008. Thankfully, we were able to repair it. Therefore, the risk of lending, the risk of participating in the financial market is positive. That is why the risk-free rate is always positive whenever you study finance. There is a compensation for systemic risk that is embedded in every discount rate. And whenever we teach finance, it's one of the basic fundamental building blocks. Now, what central banks decided was, let's ignore that. What we care most about is stimulating the economy by inflating asset prices. And we will ignore systemic risk because we believe, don't worry, central banks will be infallible. Don't worry, governments will be able to pay their debts. And they kind of overlooked this very basic fact, which is that systemic risk is positive. Therefore, interest rates actually have to be positive, in my opinion, because of the very nature of risk itself, systemic risk. And so by making the mistake of lowering rates to 0 and below, the central banks forced the system to underprice systemic risk throughout every single asset class that exists. Now, the concept of negative yields ignores systemic risk. It also suggests that you and I are entering a contract where I'm guaranteed to lose money by lending you money. That is just not something that people should do in finance. So this goes very deep. It goes very deep. And so I don't believe it is a success to have 16 trillion of negatively yielding debt. I actually think it's a sign that the system is actually really in a lot of trouble. You had the Austrian bond up 50% in a month. You had, German government debt up 20% in a couple months. For what reason? In my opinion, no other reason than a blow off top. Quite similar to .com, only way bigger, way more important, because this is government debt. Government debt is way more central to the financial system than subprime CDOs or any other kind of credit instrument that's ever been an issue in the past. So I actually don't think it's a success to see negative yields. I think it's actually really troubling, and it's a sign of how far the system has gone.
So going along with that thesis, how do you see it playing out from here? Or, if this is a blow off top, if this is a moment of capitulation, what does that mean for the months ahead?
Well, the two of the most important places to look are the banking system and then the credit markets. And those two things are both in trouble, meaning if you're a bank, you have to be able to make money by lending. And what negative rates do is it forces interest rates negative, and it also forces the yield curve to be flat. Those two factors make it very, very hard for banks to make money. So when we look at the equity market prices of European and Japanese banks, not surprisingly, they're near all-time lows in Europe and near decade lows in Japan. So in my opinion, the banking systems of both Europe and Japan are really important because central banks now, especially in Japan, are at the limits of what they can actually do to help the situation. If the BOJ were to increase their interference or their kind of influence on the interest rate markets in Japan, it would actually make things worse. So they're in a really difficult situation in Japan if the fundamentals continue to remain as bad as they are. In Europe, similarly, we saw Deutsche Bank already announcing a restructuring. So we're in the middle of the European financial system unwinding. Now, there is a German court case outstanding that is, this is a little obscure, but it's an important thing. The German Federal Constitutional Court, which is kind of the equivalent of the Supreme Court, right now is reviewing the legality of QE. They have never ruled that the QE that was done in 2015 and beyond is legal. Everyone assumes that the German Constitutional Court is going to come back in a few months and say, don't worry, QE is okay. The 33% rule that Draghi's been following, if they want to increase it to 50%, that's going to be okay. But it might not be the case. We actually don't know today. Nobody in the world, maybe the judges know, but I don't even know if they've decided, know whether QE is legal in Germany, which is just wild to think about if they were to come back and say it's illegal. The point is that there's a lot of uncertainty in these markets, especially in the financial system. So I'd start with, coming back to your question of what's most important, the financial system itself, especially in Europe and Japan. And the second point, which is credit market volatility, I mentioned a little bit about this court case. That would be something that would be quite volatile across credit markets if it were to come back in a negative way. But credit market volatility more generally is also very important to watch. If you look at the last couple weeks, credit market volatility has picked up, treasury market volatility has picked up even more than equity market volatility. Now, if we start to see that volatility increase, that could be quite dangerous because it would also be a sign that we're likely starting to see defaults. Spreads could begin to widen and we could begin a credit cycle. Now, everything I've said so far has ignored that fundamentals remain weak. Fundamentals remain very weak. China just had one of the worst quarters in 20 plus years. Industries like automotive and semiconductors and others are weakening. And so, and not to mention oil and gas, there's a bunch of industries where fundamentals are weak. So if we get credit market volatility picking up while fundamentals remain weak, ignoring whether or not the US is in a recession, we could start to have a default wave, we could start to have credit volatility. And those two things, banking system vulnerability in Europe, credit market volatility throughout the system, those would be things that could be quite dangerous in this environment.
So when it comes to all these particular issues, and I'm glad we talked about central banks already, because the answer really comes back to central banks. I mean, central banks could save, Deutsche Bank and other European banks. Central banks could, continue to do things to. So
can I just interrupt?
Yeah, please. This is what I'm getting to.
This is the key point,
right?
Which is the myth of the infallible central bank, and the reason it's a myth. Remember, in 2008, this is really important to remember. In 2008, the actions that the Fed took were not in their authority. They were granted to them by Congress. They were granted to them by a unified front of Democrats, Republicans, and the White House coming together, locking arms and saying, we need to bail out AIG. We need to bail out Goldman Sachs. We need to bail out the financial system because it's important, because we don't want the economy to go into a tailspin. Even in the United States, could you imagine today Nancy Pelosi walking into the White House with President Donald Trump and saying, hey, let's bail out AIG and Goldman Sachs? I don't know how well that would go over. Perhaps in an election year, the Democrats might say, I don't know, why don't we make this a tougher negotiation than the president would like? They may be incented to make things even more difficult than they otherwise might, given the context of the politics here. To Europe, where you were going before, they actually tried to create a merger between Deutsche Bank and another bank in Germany, and they failed. The reason is that it's not that straightforward. You have union workers on the board of Deutsche Bank, and union workers said, no merger, we don't want to get fired. And when you start to think about bailing out banks in Europe, that's where the laws become really important. So one of the key issues in this German case that I mentioned is that the German constitution and the German laws want to make sure that Germany is not financing the deficits of other countries, specifically countries like Italy. So if you got into a situation where you needed a bank bailout, you'd actually need to have the different countries cooperate. At the end of the day, might that happen? I think probably, but most likely that would take time, and therefore you'd have significant volatility in the near term. In other words, one of the best things that could happen for a bailout of the financial system in Europe might be significant volatility. If markets are down 30 or 40% and you have a lot of volatility and there's quote unquote blood on the streets, that's when maybe there's a political will to come together and give the central bank the authority it needs to act in a time of crisis, which is what happened in 2008. But the point is that there are limits to what the central banks can do at any point in time, and I think we're nearing those limits.
And at the very least, to paraphrase, if there is a central bank put, the strike price is much lower than people might currently think it is.
That's a great way of putting it. I think that's right.
So given this view of the world that you articulated, what does it mean for you when it comes to asset allocation?
And so I think what it means, coming back to the very beginning of the conversation, what are equity markets doing today? They're much more volatile, right? We saw VIX as one measure of volatility, but realized volatility has really picked up in the last couple of weeks. Valuations on any kind of cyclical adjusted basis are very high. The same is true for credit markets. Bond yields, very low, meaning bond prices very high. The asymmetry associated with any of the things that I'm talking about, meaning the risk to the downside, if any of the things I'm talking about materialize, are quite significant, both in equity markets and credit markets. For me, that means being net short. Now, I don't advise that for non-professional investors. It's really, day shorting is quite dangerous, and it can be very asymmetric to the downside. It takes a lot of, both patience and things, having a good sense of position sizing, risk management, and stuff like that. In my opinion, de-risking is probably the most prudent thing to do. FDIC insured savings accounts where you have 2% interest and you have a guarantee, at least from the government. I don't believe they will let FDIC insurance go, even in a systemic type crisis. It's pretty attractive. You have 2%, guaranteed in this market where you have negatively 16 trillion in negatively yielding credit, including, the U.S. 10-year below that 2%. It's pretty attractive in my opinion. So
maybe not the sexiest trade idea we've ever had, but
yeah, I think this is not a time to try to be sexy. Now, I mean, if for me, being short is something that does make a lot of sense.
And when you say net short, stocks, bonds,
yeah, and so the way that I construct, my portfolio is to be long progress. So I'm long this conversation, like I'm long transparency, and there's a reason why @ParanoidBull, my Twitter account, is somewhere where I share my ideas. I believe very much in the mission of Real Vision and very much in the modernization of finance. And so being invested in themes like increased transparency in finance, themes like increased transparency in media, and companies that are benefiting from that, both public and private, holding that forever, to me, is a great thing to do. Now, being short broader equity markets, being short companies that are being disrupted, yes, being short credit, which is, again, something that I wouldn't advise to your average investor, but doing these things in the context of portfolio, to me, makes a lot of sense, especially if one constructs it with not a lot of leverage and some prudence with position sizing. I think it's the right way to go.
Well, David, I'm along this conversation too. Thank you so much for joining us here in Real Vision.
Thank you for having me. It's great to be back.